Welcome to the Big Money Questions show. I'm Rachel Rickard-Strauss, Personal Finance Editor at This Is Money. This week, what is a dividend? Marcus Stadlmann's here, he's going to answer the question for us. He is Chief Investment Officer of Lloyds Private Banking. Marcus, thank you so much for talking us through dividends.
Thank you, Rachel.
What are they?
Dividends are payments by firms or funds, and therefore I think we should probably focus on firms here,
Okay.
on equities, but they are a share of the profits of a company, and there are rules around dividends. In the UK they are defined by the Companies Act 2006, and that means that the company can decide how much of the retained earnings over a certain period, minus the retained losses, it can pay out to shareholders. And that again depends on decisions the company makes on how much money to spend on the development of the business, for example, or how much money should go back to creditors, for example, the repayment of a loan. An example of money spent on the development of the business would be to buy or build a distribution center for certain products, and how much the company wants to return to shareholders. That's a key question as well.
Okay, so every now and again a company will look at how much money it's made and take out how much money it's had to spend to make it, and then whatever that profit is, it decides, well, how much of that does it want to give back to the shareholders, so the people who own a small amount of that company. And the amount that they return will vary depending on all sorts of things, it sounds like
Exactly.
you're saying.
So, yeah, a metric that is typically important to investors is the dividend yield, which is basically dividing the entire dividend payment going to all shareholders by the market value of the company. We're talking about public companies here, listed companies, and that yield is a very important metric. And the dividend payments are typically either paid on a quarterly basis in the UK, mostly every 6 months.
Okay, and why would a company pay out money to its shareholders every now and again? And if the company's doing well, then the profits are going up and shareholders will benefit from that anyway. So what's this dividend about?
It has to do with the whole proposition of investing in companies, namely that investors can participate in the profit growth, in the profits of a company, and dividends form an important element of the total return investors would achieve by way of investing in equities. Historically, if we look back over the last decades, dividends have contributed about 50%, half of the total return, obviously the other half coming from capital gains. And there have been periods when dividends were relatively low as a percentage of the total return, when equity markets boom, for example. And there have been periods when, which is more stable, is a bigger portion of the total return.
So there's no hard and fast rule, it sounds like, from what you're saying, that a company will use to determine how much it pays out to its shareholders. So it will look at all sorts of things. First of all, how much profit it made in the first place. Second, if there's something else that it would rather spend its profit on, if it needs to invest more in the company to get bigger profits later. Is there any kind of rule of thumb, the types of companies that pay out larger dividends, or times that companies are likely to pay out larger dividends?
There are many considerations. One important consideration is the stability of the cash flows of the company. So how much money the company gets in every quarter or year, and how that varies over time. A company that has relatively stable cash flow can, in theory, pay a higher dividend than a company that has very volatile, fluctuating cash flows. But then tax considerations come in on both sides, both from the company's perspective, so how much money they pay on profits, and also from the investor's perspective, because there are alternatives to dividends, right? If companies want to pass cash back to investors, they have alternative means as well to dividend payments.
Okay, so what are the implications then for me as an investor if I'm being paid out regular dividends from companies in which I've invested? Will the taxman want a slice of that?
So the taxes are paid before, from a company's perspective, before the dividends are actually distributed, paid to investors. But if we think about dividends and capital gains next to each other, they have different tax rates for investors, and that plays a role. And with the alternative I just mentioned, I meant that companies could also buy back shares, which is also a way of returning money to investors, but not necessarily directly, because in most cases that means buying back shares and retiring those shares or cancelling those shares means that the value of the remaining shares rise, and that benefits investors in a different way. They wouldn't necessarily get a payment into their account, like in the case of a dividend, but from a total return perspective, right, over the long term, adding dividends and capital gains together, that might make more sense from an after-tax perspective.
Mm-hmm. To what extent can we see dividend payments as a kind of barometer for how a company is doing? First of all, the consistency with which it pays out, and also the size of the dividend payments. Can you say that a company that pays out big, frequent dividends is doing better than one that pays out less or with more volatility?
That's a very good question, because the signal of a dividend payment, in comparison to the previous payment and how it's been communicated or how any change is communicated, is extremely important for investors. It might sometimes not actually be that important, but companies and investors think very hard about dividend payments, and both sides will see the size of the payment and the variation as a message from the company to investors. When decades ago the flow of information from companies to investors was very limited, because we didn't have the media available that we have today, then the dividend payment was one of the few very specific numbers that you could actually evaluate. And when investors at the time thought about dividend payments, they were looking for consistency, and consistency signaled quality to investors. Today it's slightly different. Companies have more options, and it's not as strict as it was decades ago. But as we saw recently, when General Electric, a big US company, reduced its dividend by 50%, by half, from 24 cents per quarter to 12 cents per quarter, it had a huge effect on the share price, and the share price on the same day when this was announced fell by 7%. So that tells you that the perception of the size of a dividend payment and how the company communicates it plays a big role still for investors.
That's so interesting, that it's not just about a kind of mathematical equation that a company will look at to decide what their profit is and how much they can afford to pay out and how much they want to invest and where tax fits into that. And a lot of it is about sentiment as well, and the signals that you're sending to your investors about how robust your business is, how things are going, and an indication of how you see the future of your company as well.
Exactly. And apart from the dividend payment and linked to it, there is what's called the payout ratio, right? So the percentage of profits which are paid to investors via a dividend, and that payout ratio will be a topic of discussion between investors and the company very frequently, because it will be put in context with the investment plans of the company, the stability of the business, and many other metrics which are relevant for valuing a share or a company as a whole.
I wanted to ask you about income investing versus growth, because that's something that seems to come up a lot, and that's all kind of related to this idea of dividend payments as well, isn't it? Could you just give us a simple explanation of the two and what we're talking about?
Yes, so income investing is essentially a strategy that looks for constant cash flows from investments to the investor. That's true for both bonds and equities. For bonds, an ongoing flow of cash would be via coupon payments, which are either fixed or variable, but they are more certain than dividend payments by companies, and that's a strategy which maximizes that cash flow rather than the capital gains, which are inseparable from the investments, both from bonds and equities. While a total return strategy looks at both dividends or coupons and capital gains at the same time, and only looks at the total number, not thinking too much about what the source of the cash is, right? But obviously, in one instance, there, without doing anything, if you just hold a stock or a bond, you're receiving ongoing payments, that's coupons and dividends. In the other situation, you actually have to sell your shares and bonds to make a capital gain, which will then be paid into your account. And so the two strategies are quite different. It depends obviously on your objectives, and some investors prefer to have those ongoing payments, and they would actually support their spending on other things, while other investors are saving for retirement. They're investing for the long term, where it is less relevant whether the return will come from dividend payments, ongoing cash flows, or whether it will come from capital gains. And it brings us to another important topic, which is compounding. Namely, if you reinvest the return, the dividend or the capital gain, into your portfolio, then you are actually in the end maximizing your return over the long term. If you don't do that, if you spend the dividend on, say, a car or Christmas presents, then clearly you don't reinvest in your portfolio, and the return in the next period is not increased by an increase in your investment, which would happen if you would just invest back the dividend or coupon into your portfolio.
Because that's often where the big growth comes from, isn't it? Is those dividend payments and then reinvesting that, and then that compounds and it continues. It's so easy just to look at the share price of companies and how the value of your investments is increasing, but it's those regular payouts which, if you don't spend, can end up being what gives you the growth.
Exactly. So it is a very, very important element of long-term investing, especially because it might not make a huge difference from one year to the next, but over a 10 or 20-year period makes a huge difference, and sometimes can even double your return if you reinvest the income you get from your investments in the portfolio.
I wanted to ask you about people who don't know that they are necessarily receiving dividend payments. I mean, if you're not an active investor, if you're not picking out shares, for example, and on platforms and etc., could you still be benefiting from dividend payments without realising it? Are there other areas in which that might be affecting your life?
Well, most of us, one way or the other, either via a corporate scheme or any other means, are saving for retirement. It is very likely that these retirement savings are again invested in either bonds and shares directly or indirectly via unit trusts. Then ultimately, it benefits your long-term outcome, your pension, if there are dividend payments, there is a high total return from your investments, and therefore, one way or the other, it is a very relevant event that a company pays a dividend for most people, even if they don't think about it, even if they don't understand their retirement savings and how they're invested in a great level of detail.
So basically, if you've got a pension, you will be receiving dividend payments. It's just they're not going straight into your bank account, or you're not told about it because you can't access your pension anyway until you're 55 or later.
They go back into your scheme, your pension scheme, and then once that comes to an end and you receive ongoing payments, pension payments, then that's how you receive back dividends, but also any other kind of return that is being made by the pension scheme.
Marcus, thank you so much for talking us through that.
Very welcome. Thank you.
And thank you for joining us for the big money questions.